high. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standard Banking Show, where we bring you the story behind the latest developments in the banking sector. It is the 22nd of February and I am Ruchika Chatravanshi. In our cover story this week, we will answer why are KYC norms being ignored. For Banker's View, we have with us Chandrasekhar Ghosh, MD and CEO of the Bandhan Bank. How is a payments bank different from SFBs and universal banks? That's what we are talking about in our Banking for You segment. Tamal Bandhopadhyay, our consulting editor, joins us for his expert take, and at the end of the show, we will tell you the results of last week's poll and the question for this week. The recent regulatory storm that has engulfed Paytm Payments Bank is a result of its own doing. According to reports, the Reserve Bank of India presented the company with multiple opportunities in the past 7 years to fine-tune its compliance issues, one of them being deficiencies in the Know Your Customer, also known as KYC process. However, Paytm's is not an isolated case. RBI has previously pulled up many banking and fintech entities for non-compliance with KYC norms. Kasturi Akhil finds out why KYC norms are being violated and why this violation is so common in this sector.
After multiple warnings from the RBI, an alleged violation of KYC norms seems to have been the final straw, which led to the clampdown on Paytm Payments Bank Limited by the banking regulator. KYC, a basic necessity for any financial services firm, is authenticating the identity of a customer by a financial institution before they are offered any financial services or products. The RBI has made it mandatory for all financial institutions to verify their customers based on supporting documents submitted to ensure legitimacy. This authentication process helps keep track of a bank's customers and prevents instances of financial fraud like money laundering. Not just Paytm Payments Bank, but the central bank has pulled up several other financial services firms in the past for breaching KYC guidelines. Airtel Payments Bank and Bank of Baroda's BOB World Mobile app faced the ire of the RBI for inadequacies in their KYC processes. In 2018, banking entities including Bank of Maharashtra, Dena Bank, and Oriental Bank of Commerce were also imposed with a monetary penalty of 1.5 crore rupees each by the RBI for violation of KYC or anti-money laundering norms. The question arises, why are KYC breaches such a common phenomenon in the banking industry?
The issue I see is more of an operational challenge along with a development challenge because the pace of growth has been very fast. RBI has obviously, like any law, RBI has come up with the KYC norm over a period of time, seeing how the digital has impacted the market. A normal, the digital business today has a QR code anywhere. So that includes people from all stratas of the society. That also includes people from the stratas of the society who find it difficult to find KYC documents. So it is not just I don't see it as a single layer problem.
According to industry observers, the framework around KYC compliance in India is dynamic and subject to frequent updates. Financial institutions need to keep abreast of all these latest updates in compliance norms mandated by various authorities such as the RBI, the SEBI, and the Ministry of Finance. Organizations sometimes struggle to understand the nuances due to lack of adequate expertise and end up paying hefty penalties. Moreover, adapting their systems to comply with the latest guidelines can be costly, which mostly small, medium, and new fintechs struggle with, as it requires them to invest in technology and staff to train them to meet KYC requirements. Speaking of fintechs, one of the key challenges they face is carrying out KYC processes, especially in smaller cities, is weak technology infrastructure. The problem was further exacerbated by the RBI's amendment in KYC norms earlier last year that required lenders to either conduct a video customer identification process or adopt an offline process, which led to rise in costs. In 2023, RBI tagged the centralized KYC database and DigiLocker as high risk, meaning that accounts opened in non-face-to-face mode shall be subjected to enhanced monitoring until the customer's identity is verified through video KYC or a face-to-face manner. According to industry estimates, a video KYC can cost anywhere between 15 to 30 rupees, and the cost of a physical KYC can go up to around 100 rupees. On the other hand, searching data on the CKYC registry is free, and downloading the data costs only a rupee. Industry insiders argue that KYC issues around Paytm Payments Bank are not unique to one company, but are a sectoral challenge in general. To thrive in the banking and fintech business, one cannot shy away from the prerequisites of the sector, and banking compliances are an obvious offshoot of such a business.
At the end of the day, the end idea of the company is never non-compliance, and the simple reason is they would not want their legal team behind their head. And their legal team would also have been following up with them. What we have to understand here, these are two very different parties. One is a regulator. Their idea of looking at the market is very different. They are looking from a regulator, a watchdog's perspective, and they're looking at a market. They don't have, they are not doing business. They are regulating the business that is happening. So first of all, there will definitely be operational issues, and I think the whole idea here is to find out where the issue is.
Experts believe that adapting businesses and systems to updated KYC guidelines can be a cumbersome process in a world where technology is ever evolving. And especially now, given the scale of Paytm's operations, the regulatory crackdown on Paytm Payments Bank will immensely help the rest of the banking and fintech sector to understand the enormity of KYC compliances, thereby helping them to learn and adapt to the processes faster.
Well, next week, Finance Minister Nirmala Sitharaman will be meeting both RBI and fintech companies over all these issues to find a balance between ensuring compliance and also ensuring that innovation is not discouraged. Bandhan Bank Q3 earnings reported 2.5 times jump in its net profit, mainly due to foreign provisions. Its MD and CEO Chandrasekhar Ghosh spoke to Business Standard's Manojit Saha about the bank's performance and more.
Hello and welcome to the Business Standard Banking Show. Bandhan Bank, which recently announced its third quarter earnings, reported around 2.5 times jump in its net profit to 733 crore, mainly due to fall in provisions. However, slippages were elevated. Also, the bank is in the news as the National Credit Guarantee Trustee Company is auditing its loans, for which it has provided an insurance. To clarify some of these issues and speak on the future growth path of Bandhan Bank, we today have Chandrasekhar Ghosh, the MD and CEO of Bandhan Bank. Mr. Ghosh, welcome to the show.
Thank you, Manoj.
Thank you, sir. Thank you. So let me start with and quickly check about the latest issue which is going around. Is the wanted to know why is the National Credit Guarantee Trustee Company is conducting a forensic audit on the loans, which is the audit is being conducted by EY. So what is the reason for this audit?
If you see that under this the insurance, we are in the time of 2021 of financial year, we are whatever the normally we are giving the credit to the customer, and that loan under this the scheme are insured, so that the government scheme we are able on that. Second point on that, when that time was in a portfolio is in nearly 20,000 crores on that. And those the portfolio are not repaid. That means out of that, the 85% of the portfolio, 19,000 crores, the customer already paid to us. And the balance, whatever say that the nearly 3,000 crores around on that. and that amount are their NPA is the less than 15%, more than 15%. So those of this, the portfolio are coming under this, the claim settlement from the insurer, which is called as a NCGTC. So according to that, the first tranche last year, there is a restriction on that. You can be like to one time apply in a year, not more than one time. Second is there, this portfolio will be like to 6 months minimum matured of the NPA. That means up to the NPA, they will be like to more than 6 months.
Yes.
And there is a 29 lakhs of this customer in like on that. So when we applied the first time, we got that money. And next time, this financial year, we applied the second tranche, and they are asking to audit on that. And I feel that this money is a big, so it's a need to check on that. That's everything is like perfect. And when this happened, then some queries have been asked, and we are provided some queries. When we provided that queries, they would like to again further check whatever we are reply, and it is in how much it is in correct. That will be need to further audit of the details with the total portfolio, because the first time they are done in a sample basis, and sample is a very small amount of that. So this is the second term. They are doing it on that as a full data, and they are asking the different this data from us, and we are provided their data, and this is going on. Whenever it will be like to finish on that report, and then they will be like to given that decision, and will be like to money come back.
So you're saying that because your claims were around 2,000 crore, that is why this audit was required.
Correct.
And the amount involved right now, which is not yet recovered, is 3,000 crore, involving 29 lakh customers.
Yes, correct.
So that is why the audit is. But is it a forensic audit really?
They have put it, the name is a forensic. I feel that it is a very detailed audit of that.
Is the regulator also in touch with you regarding the entire process?
No.
So that is a stressed asset. One could like to classify that as a stressed part. How much of this you think can slip? This has already slipped. This NP has
It
already
is
slipped.
already slipped. Another point is, Manoj, this is the total portfolio. 89% already we provisioned.
89% of the total portfolio which had slipped has
already
been
provisioned.
provisioned.
And if you see that the 20% as of now, out of 970 crores, we already recovered.
Right. So recovery is the point you mentioned, steady recovery of 400 crore. However, the recovery part is slightly lower than market expectation. Do you expect the recovery figures to go up in the coming quarters?
Yes, you are. Yeah, we are expected on that. If you see that other part, the microcredit is actually, this is an thinking about the customer behavioral credit. Up to financial year 22, they are not even possible to attend the group meeting that have been finished. And 22-23, they are started to come to the attendance, and not in a full time. Full time means in the earlier as a pre-pandemic, not like that. 50%, 60%, 70% that has come. Bonding has not yet come fully, because bonding will become late time taken process on that.
Yes.
No. Because if you say that the customer is divided in a two part, one part before the pandemic customer, don't know that about the bonding and attendance, but those are after the pandemic we are taken, or during the pandemic after that in the 2020, 21, 22, 22, 23, new customer are taken. They are not getting that much of the time on that to bonding and attendance matter as a practice. So that it has been helped on that to some slippage has come. So what we see that the 23-24, there's a very good bonding and attendance has come such a way, which again shows that the data also shows that the slippage has come down. So that is the point on that. The next financial year onwards, it will be the pre-pandemic type of behavior we like to show you.
The recent RBI action against Paytm Payments Bank has sparked widespread discussion on payment banks. People are also curious to know about payment banks and how they differ from small finance banks and universal banks. That is what we will explain in our next report by Ayush Mishra.
The Reserve Bank of India issues two types of banking licenses: Universal Bank License and Differentiated Bank License. Differentiated banks, also known as niche banks, cater to the specific needs of a certain demographic segment of the population. Small finance banks and payment banks are examples of differentiated banks in India. A universal bank is a financial institution that consolidates the three primary banking services within a single entity. These three banking services are wholesale banking, retail banking, and investment banking. Essentially, a universal bank functions as a retail bank, a wholesale bank, and an investment bank concurrently. A typical universal bank also offers other financial services such as insurance. Universal banks like State Bank of India, ICICI Bank, HDFC Bank, and many others can provide almost all products and services. On the other hand, differentiated banks can only give selected products like credit, payments, deposits, etc. with RBI regulations. Small finance banks or SFBs are a type of differentiated banks. They serve as specialized institutions providing essential banking services and credit facilities to underserved segments such as small businesses, micro and small industries, farmers, and unorganized sector. Capital Small Finance Bank, Ujjivan and Utkarsh are some examples of SFBs. SFBs must adhere to RBI norms and comply with prudential regulations including cash reserve ratio and statutory liquidity ratio maintenance. If an SFB aspires to transit into a universal bank, it has to have a satisfactory track record of performance for a minimum period of 5 years. Small finance banks can engage in forex sales, offer mutual funds, insurance, and pensions, and have the potential to transition into full-fledged banks. However, they are restricted from providing large loans and establishing subsidiaries to deal in complex financial products, maintaining a focus on serving smaller businesses and underserved communities. Payment banks such as Airtel Payments Bank and India Post Payments Bank operate on a smaller scale with no credit risk involved. While they conduct various banking operations, they are restricted from advancing loans or issuing credit cards. These banks exclusively accept demand deposits like savings and current accounts, and they cannot establish subsidiaries for non-banking financial services. Payment banks aim to enhance rural banking, provide diversified services, and promote social and financial inclusion. Payment banks can provide internet banking and sell mutual funds, insurance, and pensions. They can offer bill payment services, enable mobile transfers and remittances, and provide forex services and cards for domestic use. However, they are restricted from issuing credit cards, extending loans, handling cross-border remittances, and accepting NRI deposits.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Now that we're all caught up on different kinds of banks, let us move on to our expert take segment. I spoke with our consulting editor, Tamal Bandhopadhyay, to discuss some of the new challenges on the banking turf. Here's the chat. Hi Tamal, welcome to the Banking Show. This week in your column, you've talked about new challenge new challenges, in fact, on the banking turf. And I see that the way you've explained it, it varies from bank to bank. Can you take us through the broad trends that have emerged after the results, and what are the challenges that you see for these banks?
Yeah, thanks, Ruchika. Uh, it was a little late because I was waiting for all the bank to come up with their December quarter earnings. So what is happening is the past 6 quarters, what we have seen that we are every quarter we are going gaga over the great performance of Indian banks. Our focus is on their net profit, and of course repeatedly we have been saying that their health is pretty good because NPAs are coming down, have come down to historic low, and so the provision coverage ratio, not provision coverage ratio, but the provision in absolute term is going down. Provision was actually eating out most of their operating profit, a large part of their operating profit that is coming down. That has been the trend. Now, what if you go for the December quarter earnings, what we see is this: yes, the trend of that trend continues, so that the provision is coming down, and net profit is going up, and of course, as far as the NPAs are concerned, they are pretty contained, not too much of fresh slippages. We are talking about new slippages on personal loans, retail loans, etc., but that's not much of a headache. The biggest two key challenge, and they are interrelated, I would say, is this one is this it's not exactly new, but the focus is on there. How do you support the credit growth unless you have the right kind of deposit growth? And there, bank to bank varies. You will see that some of the banks, their credit growth is 3, 4, 5 times than their deposit growth. Now, deposit is the raw material to which can be used apart from the capital to create new credit. So where do we do that? And second is the cost of. Till now, we are talking about cost of credit. That's the NPAs. Now we are talking about the cost of deposits. Now it has to come down. I mean, unless you maintain the cost of deposit, which means you need to have more CASA, which is current and savings account, your NIM, so-called NIM, which is net interest margin, the money you earn from your giving loans and the money you spend on giving deposits, is coming down. NIM is coming down again. Most of the banks, if you see year-on-year basis, their CASA is coming down and NIM is coming down. They are related because CASA is the low-cost fund. Now, why this is happening? Because the saving community are exploring the other investment avenue. They are shifting from savings bank to fixed deposit. They are shifting from savings bank or the banks to mutual fund. You see how the mutual fund AUM is going up. You see how the SIP is going up. And some of them also even shifting to direct equity market. You see how the demat accounts are rising. So it's something which the bankers have not seen. Most of the bankers, current bankers in their lifetime, which is 30, 35, 37 years, the senior bankers have seen. So that this is the new thing. You have to get the deposit, the CASA, you have to bring down their cost of funds, and you need to maintain the NIM. These are the new challenges.
Yeah. Tamal, the other big news last week was of the electoral bonds order of Supreme Court. I want to ask you a very basic question, that if the Supreme Court has told a bank to reveal the names of customers, so to say, will this come in the way of the confidentiality that banks are supposed to maintain about their customers? How will banks deal with it? How will the bank deal with it?
Yeah, it's a very critical question. I think there's a lot of confusion among people. Yes, if you go by the Banking Regulation Act norms, confidentiality need to be maintained. That is about your banking activities. Ruchika, you are a bank's customer. Now, Tamal cannot ask a bank about Ruchika's activities, the deposits and what she's doing with her money, etc., etc. But the Banking Regulation Act also gives certain exceptions, and one of the exception is this such a case where judiciary, the court directs a bank to reveal certain information about an account, which is not exactly the personal issues, but it's something else, which is the case in the case of electoral bond. So the Banking Regulation Act will not come on the way revealing the details of electoral bond issuers and the money what they have given and to whom they are given. There's a clear exception, and that, I mean, as I said, that Supreme Court can prevail, and there is a clause within the Banking Regulation Act. So you can expect. You are looking for some excitement. You can expect the data will come out in the market. Yeah.
The other, I don't know if it is excitement, but RBI's action on Paytm recently.
Yeah.
Do you think there will be some sort of a spillover effect on the overall payments networks?
Yes, there will be a spillover effect, but that's a positive effect, I would say, because the regulator has made it very clear that it is not against innovation. So you would continue to see new instruments, and particularly, you say, Ruchika, that India is a vanguard as far as the payment system is concerned. Globally is the most, I would say, the most agile, and most of the things are happening. And there are many startups and there are many entities there. But I think it's a very stern warning to the entire that space, the entities who are who regulates them. That's a little vague area. They take certain advantages of that, and it's not exactly the way it should happen. In some of the cases happening. So yes, there will be a spillover effect. Those who wanted to circumvent certain rules and regulations and getting a shortcut, they will be warned, and it's a very stern warning that even Paytm cannot. Paytm is a synonymous with the payment system in India. Even Paytm cannot do that. So you guys have to be very careful. I think it's effect is there, but it's a very positive effect.
Yes. Indeed, they have set an example, maybe out of the action taken against Paytm, and all the other networks will heed RBI's caution. Thank you so much, Tamal, for sharing your thoughts and clarifying so many things about the pressure on NIMs and, of course, the electoral bonds issue as well. As always, thank you so much for joining. We'll see you next week.
Thank you.
It is time now for our poll results. Here's what we asked you last week. Is your bank transparent on charges? Our poll results show a very telling picture. 64% of our respondents said no, the banks were not transparent on charges, while 36% said yes, they were transparent. The recent regulatory action by the RBI against Paytm has raised several concerns among users who may be preferring to use UPI instead of these digital wallets. We want to find out from you. So here's what we are asking you this week. Will you ditch your digital wallet in favor of UPI? Our poll is open today, that is Thursday, and you can respond on Twitter, Instagram, LinkedIn, and our website. That's all we have for you today. We will be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.